Yeah, we were just injecting a bit of Bitcoin signal into the general consensus conference, so talking about markets with Samson Moe and Jay Van Stratum, who's an analyst on Bitcoin metrics. It's difficult to make short-term calls, but I think people who are looking at the market have not been through multiple market cycles, and so they're reacting to price variations of 5%, but really, that's nothing compared to normal Bitcoin volatility. In previous cycles, you've had like half a dozen 30% drops during a bull run, right? And that's par for the course. So I think we've got new investors who are not as accustomed to volatility, but actually the volatility has dropped quite a bit in this cycle anyway. So it's actually relatively calm and low volatility on a Bitcoin scale. Now, of course, that looks volatile for typical investors in shares and so on, but still, for Bitcoin, the volatility is lower. I think it's better to look at the regular market, so individual investors and institutional investors. So institutional investment money, apart from like sovereign wealth, is largely sort of pension funds and mutual funds, so managed money on behalf of individuals. And so I see a lot of growth opportunity in that. Those pools of capital are quite large. Now, it's a bit of an open question about whether it's a good thing if governments invest in Bitcoin or not. Now, they may choose to, and that will shorten the growth cycle for Bitcoin, because it will have a knock-on effect. As soon as a few major countries start to build a Bitcoin reserve, then other countries will competitively follow suit, and so it could pull forward the Bitcoin adoption overall track. Well, I think that the ETFs are an accessibility thing, so it helps a wider group of people get access to Bitcoin. And so in the same way that people get interested in Bitcoin through all kinds of different exposure or introduction points and then learn more, I think that people that come through exchanges or through ETFs can then learn more about the benefits of self-storage and start to store some of their Bitcoin directly. It's a better insurance policy in that way. And I think also the technology can be made easier to use and safer to use for less technical users for self-custody as well. So I think both of those things are converging. Well, historically Bitcoin has been on a market cycle punctuated by the halving, so a roughly 4-year market cycle, typically with a couple of years of bull market and then a couple of years of sideways or bear market. Now, there is a bit of a debate at present if Bitcoin is seeing a diminishing return across cycles, or if we're going to see an upswing in adoption. So most technologies go through an S-curve where there's like gradual sort of grassroots and niche adoption that becomes more mainstream and widespread, and as it's a network technology, you get network effects take hold and you get a period of hyper adoption. So I think we'll see during the next cycle or two if the diminishing returns theory breaks or not. So I think the diminishing returns theory could be taking a false signal from the last cycle, which was muted by lots of things, COVID and geopolitical instability, supply chain, some DeFi failures and bankruptcies. All these kinds of things had an effect on the cycle. I think without that kind of overlay, the last cycle would have seen a higher price already. So that could mean that we're still on track for a higher return this cycle. And if the S-curve kind of more rapid mass adoption takes hold, which could be institutional, easier access to a wider pool of investors by ETFs, then perhaps we'll see a reversal of the diminishing returns effect.